Good evening, members and senior members of the profession and ladies and gentlemen. A very good evening to all of you. And I welcome you all for the today's virtual CP seminar on recent developments in capital gains. Though we are hearing from the beginning of the profession regarding capital gains, every time there are changes. And today's speaker is Prachi Parekh from Mumbai. Young chartered accountant and law graduate with 12 years of experience in direct tax laws. Formerly, she was engaged in coaching of CA final and inter students on the subject in direct taxes with leading coaching institutions, including WIRC. She was presently the part of the editorial team at Tax Sutra. With this brief, I'm introducing today's speaker, Prachi Parekh, to the August members. And I request the speaker to go on the subject and finally give the time for the members to ask for queries. Thank you, madam. Thank you very much.
Thank you, sir. Good evening, everybody. It is my pleasure to be a part of the, a speaker for the SIRC seminar on direct tax, and I hope it is we all find it fruitful. So, respected seniors in the profession and my colleagues, the topic for the evening, as we all know, is recent developments in capital gains. So, typically speaking of capital gains, as we all know, it's not something which has been recently added into the statute book, like the recent developments in the case of VDAs, that is taxability of virtual digital assets or sale equalization levy. The provisions pertaining to capital gains have been in the statute for a considerable amount of time, and they have constantly been developing as and how newer transactions have evolved. The head has always seen some or the other amendments. So we also had these amendments which were related to taxation of indirect transfers, which were resultant of the Vodafone ruling, which came back in 2012. We have now recently seen provisions with regards to taxability of joint development agreements. Then we have moved on to from compulsory acquisition, conversion of stock in trade. We've moved on to several specific provisions which are brought in the chapter to cover specific developments which have taken place in this arena of taxation. So my coverage today is going to be predominantly covering the changes or the amendments which have been brought about in this particular chapter from the past two Finance Acts. So Finance Act 21 saw a plethora of changes being made to the head of capital gains. The entire provisions which were dealing with taxability of amounts withdrawn by partners in case of reconstitution or dissolution of firms underwent a sea change. We also saw taxability of provisions which were there as regards the slump exchange. Moving further, we saw depreciation on goodwill which was abolished, and then there were resultant changes brought about in this particular chapter. So basically the last 2 years have more or less modified a lot of sections in this particular chapter, and that is the high point of this presentation for the evening, I would say. Apart from that, I have tried to cover in certain recent judicial decisions which are of use to the practitioners in general. They are on the areas which we practice on a routine basis. So maybe JDA taxability or Section 54 exemptions, or when does a capital gain trigger in case of JDA transactions, etc. So those kind of recent rulings I have compiled. So my presentation is divided basically into two parts. One is covering the recent amendments. The second part I have devoted to covering the important judicial decisions which are there related to the subject. So I think we'll go through the presentation now. Like Sir said, any queries, we could park them towards the end of the session. I would be taking them all. And yes. In case there is any issue with the audio or so, please
yes,
do.
I will let you know. I'll be there throughout the session. If there's any disconnection,
Then I would possibly put the camera off, because then there would be a bandwidth issue.
maybe you can start sharing the screen. After a while, you can put off the camera, and then you can turn it on whenever the bandwidth is good.
Correct. Is my screen visible?
Yeah, it's visible, ma'am. Visible.
Okay. So let us go ahead with the presentation. Like I said, my coverage is the recent amendments. So the first part which I would be covering is taxability of slump exchange. Then there are provisions which were dealing with taxation on dissolution or reconstitution of firms, AOPs, which is the second important part here. Again, what is the provisions for taxing of receipts in the form of money or any capital asset which is received by partners in case of reconstitution, and then amendment to section 48. These are the main changes which we are going to deal with in detail in today's presentation. The next part is the recent pronouncements, judicial pronouncements. So let us take up the first part, which is taxability of slump exchange. Now, as we are all aware with the provisions related to capital gains, there was a specific provision which dealt with taxability in case of slump sale transactions. So the typical or the specific aspect of these kind of transactions was that the entire consideration, there was maybe a undertaking which is transferred, or there was a division of a particular business which is transferred, and then the taxpayers used to usually opt for the slump sale mode because it was a convenient way to determine the taxability. Unlike in a transaction of amalgamation or demerger or a item-wise sale, there were a lot of legal issues as far as the first two are concerned. And when there is an item-wise sale, there is a lot of effort that goes into determining the capital gain component. So slump sale was a easier way so as to say that the entire undertaking as a lump sum is transferred and only one value used to be assigned to it, and the net worth of the undertaking was adopted as the cost, and accordingly based on the number of years you have held the undertaking, it used to be taxed as a long-term or a short-term capital gain. So that was 50B, which was related to slump sale. Now, typically what people had found a way out was, in slump sale, the consideration usually would be in terms of money. But there were certain transactions which were designed in a certain way that the consideration for such transfer of undertaking used to be in some kind, or maybe some shares which were assigned. So in a conventional way, this transaction was not typically covered as sale because there was no monetary consideration involved. It was like a barter. So you transfer the undertaking, you receive shares of some other undertaking, or you receive some other asset. So there were judicial precedents which held that this slump exchange is not covered within the meaning of the term slump sale, and therefore there is no mechanism to compute the tax in case of slump exchanges. So there was a Madras High Court decision. This is a recent one, I think 2020, in the case of Ariva T&D Company. There's a Bombay High Court decision in case of Bharat Bijli. So or somewhere the principles in these rulings was that slump exchange doesn't form a part and parcel of slump sale, and therefore it should be treated separately. You cannot compute tax under the provisions applicable for slump sale. So keeping this background in mind, the Finance Act 21 made changes to the definition of slump sale, and they said that this definition will now also cover other modes of transfer, thereby covering slump exchange. So now the situation post the amendment is such that even if there is a particular barter transaction wherein undertaking of a unit is transferred, and in lieu of that certain shares are assigned or some asset is assigned or some other undertaking is assigned, it could be any particular asset which is assigned, it would also be a taxable event, and the transferor would be liable to pay capital gains tax. So this is now they have amended the definition for slump sale itself to cover slump exchange. Now, under a slump exchange transaction, what usually happens is, like I said, the consideration is not in terms of monetary form, it is in kind. So yeah, I will put on the camera in a while once I resolve this issue. Okay. So in this case, the consideration is in kind, and then there again arises a question as to how would this particular consideration be valued. So the CBDT prescribed a rule 11 UAE recently, some months back, which gives us the mechanism to determine the consideration in case of these transactions of slump exchange. So once they brought out the amendment, they also gave the mechanism, and that is how now the entire definition of slump sale is a widened one. It also will cover other modes of transfer, more specifically slump exchange. So what is the result of this amendment? So there were a lot of transactions which were designed in a particular way that slump sale would be restricted to situations wherein the consideration for the transfer of undertaking was paid in money. If there was any consideration in the form of shares being assigned or any other asset being assigned, those transactions were out of the taxability ambit because we had decisions to support our case. Now, with this particular amendment, such transactions have also fallen in the taxability ambit, and now one has to be careful when we are designing our or rather planning our transactions to see that how far we are valuing the consideration, whether we are compliant with the provisions or not. So it has basically widened the scope and just taken away some element of tax planning from this particular aspect of designing the transactions. So this was about the change in the definition of slump sale 242C, that is, and now we also have slump exchange covered there. Now the next set of changes, they are huge. I'm sure all of us must have been through them when they were introduced last year. But slowly and steadily, we are going to see its implications because we have still not grasped completely the effect of these changes as to what all is going to be the ultimate effect. So just to give you a brief background, prior to these amendments of Finance Act 21, there were two provisions under the head capital gains which dealt specifically with respect to partnership firms. So we had section 45(3), right, which is wherein the partner brings in some particular capital asset as a part of his or her capital contribution to the firm. And then we had the taxability mechanism which said that the capital gains would then be taxable to the partner, he would be the transferor, etc. And then we had section 45(4), which spoke of a scenario when the partner was receiving some kind of capital asset from the firm in the event of dissolution or retirement or otherwise. So the old section 45(4) used a word otherwise, which various courts interpreted in various ways. So some decisions said that any kind of reconstitution or a change in the partner's profit sharing ratio would also come within the meaning of the term otherwise. So we had a lot of rulings of all various interpretations there. Also, there was a question as to what would be the taxability if the partner is receiving something which is in excess of his capital account share when he is retiring from the firm. And there were a lot of issues which didn't have a conclusive solution. Somewhere to address those issues, the Finance Act 2021 brought in two provisions under this capital gains chapter, which was dealing with the taxability in case of dissolution or reconstitution of firms. Now, for every one of us who read the finance bill previously, we might be aware that earlier it was 45(4), which was substituted, and there was a 45(4)(a), which was introduced. But as the bill changed to the Act, several representations were made by various forums saying that the provisions were unreasonable or they were causing more chaos and confusion. And then that is why 45(4)(a), which was sought to be introduced, was omitted. and they introduced a section 9B, which is in the form of a deeming fiction. And then they also made some small changes to the earlier proposed 45(4). So this is the background of these changes, I would say. Let us go through what these changes were, or just do a quick recap and understanding of the changes there. So basically, we are right now dealing with section 9B on this slide, which talks of taxation on dissolution or reconstitution of firms, AOP or BOI. So section 9B was introduced as a deeming fiction. This is not a computation provision, but it is introduced as a deeming fiction. And this particular provision says, if a partner is receiving any capital asset or a stock in trade from a firm, which is in connection with the firm's dissolution or reconstitution, then this particular transaction will be a deemed transfer. Further, this will be taxable in the year of receipt of this particular asset or stock in trade by the partner, and it will be taxable as capital gain or business income. Moreover, the fair market value on the date of receipt is to be adopted as the full value of consideration. So here you have this particular deeming fiction which says that in case of any dissolution or reconstitution of the firm, the term reconstitution they have defined in the going further in the provisions. So wherever there is a reconstitution or a dissolution which take place and the partner is receiving any capital asset or stock in trade, then it is going to be deemed transfer and it is going to be taxable in the year in which such partner receives this particular asset from the firm. Correct? Now, yes. So, the entire set of amendments we will understand once we understand 45(4) as well. Now, simultaneously, they have amended section 45(4), which talks only of reconstitution. So 45(4) deals with a situation wherein there is taxation, which is taxation of receipts of money or capital asset by a partner in connection with reconstitution of the firm. So 45(4) says if the partner is receiving any money or capital asset or both, which is in excess of the capital of the balance of his capital account, and this receipt is on account of reconstitution of the firm, this amount will be taxable to the firm as capital gain. So this section speaks only of reconstitution, whereas section 9B is talking of both, which is your dissolution as well as reconstitution. And in both the cases, the gain is going to be taxable to the firm per se. So there are immediate questions which might come to all of us, whether these sections are applicable together. Yes, no, most of us would have dealt with this also possibly. Now, apart from these, what I have proposed is there is an illustration plus a comparative of all these three sections which I am discussing. So we'll first discuss the provisions, go to the comparative, and then go to the illustration to understand the impact of these changes before we take up the issues connected to it. The Finance Act also made a consequential amendment to section 48, wherein it said that if 45(4) was triggered in any particular case, then a part of capital gain which is computed under 45(4) will be reduced from the full value of consideration of the capital asset, which is the capital gain for the transfer made by the firm. Now, what amount of capital gain will be reduced? So only such proportion of the income taxed under section 45(4) which is attributable to the capital asset is to be deducted. So supposing there is a computation under 45(4) which takes place and there is some amount of capital gain which is chargeable in the hands of the firm, then a certain element of such capital gain, they have prescribed a formula for this, will be reduced from the total gain by virtue of 48(3). That is to take care of the double taxation component over here. Now, these were the 3 sections which were introduced by virtue of Finance Act 2021. Now, what was the reason or what was the rationale which led to the legislature to introduce these changes? So first of all, there was quite some uncertainty over applicability of 45(4) to various situations wherein assets were revalued or self-generated. So assets like goodwill, or there is a trade name, or there is a trademark which is individual to the firm, and all the partners have contributed to it. So how does one value it first, and then how does 45(4), the old 45(4) apply in these cases, right? Also, whenever there was a revaluation, one would be questioned whether 45(4) is applicable or no, because the old 45(4) spoke only of situations which were dissolution, retirement, or otherwise, and otherwise was left open to interpretation. So this was the first issue. The second issue was there were certain payments which were made to the retiring partner, like I said, which were in excess of their capital contribution. So we had quite a lot of rulings which held that such amounts are going to be treated as capital receipt in the hands of the partners. So again, there was no mechanism to tax those amounts either in the hands of the partner or in the firm. So considering all this and the various interpretations which the courts had accorded to it, these amendments were brought in. That is what the explanatory memorandum to the finance bill explains. Now, before we actually revisit this entire 3 sections and try to understand them in a more lucid way, let us just imagine this situation. So when a partner is retiring from the firm and he receives any particular asset or property, there are going to be 2 taxable transactions. First is qua the partner who receives a particular asset, that is his consideration in case of reconstitution which is taking place. And qua the firm, there is a transfer of a capital asset or a stock in trade by the firm to partner on reconstitution. So for both these transactions, these 2 sections have come into picture to tackle them. So when the partner is receiving some particular asset on account of reconstitution, we have section 45(4) which comes into picture. When the firm is transferring certain capital asset or stock in trade or money to a partner on reconstitution, section 9(b) comes into picture. Now, what is the meaning of reconstitution which they have defined here? So just for the information of the members, earlier reconstitution per se was not defined in the old section 45(4). This definition now finds place in section 9(b) where they have given out this particular meaning of reconstitution. So they are saying reconstitution of an entity means one or more partners or members, and not all, cease to be its partners or members. So let's say a partnership firm has 4 partners, 2 of them decide to retire from the firm, 2 are continuing, it would still imply it's a reconstitution. 2 new partners are coming in place of the 2 who have exited, it would also imply that there is a reconstitution taking place. But if all the 4 partners who are there, the old partners, they cease to be the partners, then that is not what is reconstitution. The second limb of this definition says, one or more new partners or members are admitted to the existing entity where one or more partners or members continue to remain even after addition. So you had 4 old partners, 3 decide to quit, 1 is continuing, and you add 3 more partners, it would still be reconstitution. So one common partner has to be there between the old members and the new members who are added. So these two is still acceptable. The third limb of this definition says any modification of share in the profit ratio, whether changes in partners or not, is also reconstitution. So let us envisage a scenario wherein there are 4 partners. All 4 of them are going to remain the partners of the firm. Nothing has changed except their profit sharing ratio. So that would still amount to reconstitution. And any payment which is made to the partners, let us say Mr. A's share was earlier say 25%, and now his share has gone down to 10%, and 15% of his share is taken by Mr. B and C equally. So for this particular arrangement, Mr. A receives a certain asset or some other stock in trade or anything. So that amount is still, that is still going to trigger 9B in the hands of the firm, because there has been some distribution of asset to the partner on reconstitution, meaning any modification in the profit sharing ratio. So minutely they have captured all possible changes which take place in a partnership firm, which were earlier a debatable issue because of the wordings of section 45(4). So this is the definition of reconstitution which the law has now brought on the statute book. Now, just let us revisit once. 9B is on dissolution or reconstitution. It's a deeming fiction. What is received here is any capital asset or any stock in trade or both by partner from a firm. Now I'll bring out the finer points in this particular provision. As we can see, there is no reference to money being received in 9B. So 9B only talks of a situation wherein any capital asset or stock in trade or both is received by a partner from a firm. On both the instances, it could be dissolution or it could be reconstitution, both are covered. When you look at 45(4), it talks of money or capital asset or both being received by the partner, and again there is a rider here, and the rider is that only such amount which is in excess of his capital account balance. So as we can find, there is no reference to stock and trade over here. Correct? So 9B there was no reference to money. 45(4) there is no reference to stock and trade. It is only capital asset or money, and 45(4) talks only in case of reconstitution. Dissolution is not covered here, which is covered in 9B, right? This is a consequential amendment, which we'll understand when we look at the illustration as such. Now let us look at some other fine points here. Now, like I said, section 9B is not a computation provision per se. It is a deeming fiction. So whereby it is deemed to be a transfer, and it is not typically introduced in chapter 4E, which is our capital gains chapter, but it is introduced in chapter 2, which is basis of charge. So just below 9A, you have 9B, which has come in, and that is how it makes it a deeming fiction. It is liable for a very strict interpretation, and one should always remember that it is not a computational provision. Now, what happens when one is liable to determine capital gains under section 9B? So whether the firm would be eligible for indexation benefit or section 54 EC benefit. Now, to my mind, the answer is yes, because there is nothing otherwise to preclude the firm from availing the indexation benefit or the 54 EC, provided the respective conditions therein are fulfilled. So these are another 2 points related to section 9B. Now, when we speak of section 45(4), like I said, it deals only with capital asset or money. It is not covering stock and trade. Whether indexation benefit or section 54 EC exemption would be available in this particular case. Again, this is my view. It is still not settled. It is open for debate and interpretation. But I feel in case of 45(4), there would not be any indexation benefit which would be available, one, and also there would not be any section 54 EC exemption, because particularly if you remember, 45(4) dealt with a rider which said that such capital asset or money which was in excess of the capital account balance. So in a way, that capital account balance is going to be the cost of acquisition in determining the gains, and there is no typical capital asset involved here in my view. As in, what is transferred is not a capital asset. This is just a provision to tax the benefit which a partner is receiving in case of reconstitution of firms. There is no dissolution covered in 45(4), so there is no extinguishment or typically giving up of any right. Of course, reconstitution, when there is a change in PSR, etc., would also tantamount to that. But in my view, there is no capital asset as such which is being transferred in the first place, and therefore maybe this exemption or indexation benefit could not be factored in as far as computation under 45(4) is concerned. Yes. So after these amendments were introduced, then sometime later the CBDT came out with the mechanisms in the form of Rule 8AB, which was for attributing of income under Section 45(4) to block of assets or goodwill or intangible assets for the purpose of 48(3). So 48(3) is that consequential amendment over here, where we are saying that a proportion of capital gain which is determined under Section 45(4) will be reduced from the firm's overall computed amount. So how to attribute that? For that purpose, we have Rule 8AB, which gives us the formulae for attributing this particular amount in terms of 48(3). Also, Form 5C has to be filed. This is the compliance part of it, on or before furnishing your return of income. So this is with regards to your 48(3) amendment. Now, as far as 45(4) is concerned, you have Rule 8AA, which has come into picture, which says that the period of holding for the capital asset which is transferred under 45(4). Now, particularly here, it is the partner's what is transferred by the firm is any particular capital asset or some sum of money. Now, I'm not sure whether it will apply in case of money, but with regards to capital asset, yes, the period of the amount of time that it was held by the firm would be treated as its POH. It will be just computed in accordance with the normal capital gain provisions. So if it is held for a period of more than 36 months, it would be a long-term asset, thus resulting in a long-term gain, and so on and so forth. So this is to avoid any any other dispute as regards to the period of holding of the assets. So how to determine it? That is the normal, as per the normal manner, the period of holding is going to be determined in cases where 45(4) is applicable. Now, there are some points which I would like to bring to your notice. Now, what happens if some capital is withdrawn by the partner in cases where from his capital account during the course of his business? So in the usual course of his business, if the partner is withdrawing some money from his capital accounts, whether Section 45(4) or 9B is applicable. Now, my view here would be 9B would certainly not be applicable, because it specifically speaks of a situation wherein there is it's a deemed transfer, and therefore in the course of business, if the partner is withdrawing some amounts, I think 9B will not be applicable. Also, as far as 45(4) and 9B both are concerned, they are applicable on a specific event of dissolution or reconstitution. As long as none of these events have specifically taken place, there would not be any trigger for these two sections to become applicable. Therefore, if a partner is withdrawing some amount from his capital accounts during the business, I think both provisions are not going to be applicable. Now, what happens when there is a dissolution or reconstitution and only cash is distributed to the partner? Correct? Now, when we just went to 9B, in the second time I highlighted that 9B covers only a situation wherein a capital asset and stock in trade is transferred. It does not cover a situation wherein there is a transfer of money per se. So if at all there is a reconstitution or a dissolution of firm, and there is only money which is distributed to the partner whose rights are modified, then section 9b would not be applicable in that situation. Supposing it is a reconstitution and money is being offered to the partner whose profit sharing ratio is modified or who is leaving the firm, would 45(4) be applicable? That this question is not there on the slide, I'm just asking it. So yes, because in case of reconstitution, the provision which is applicable is 45(4), and 45(4) includes in its ambit capital asset or money. So let's say Mr. A is exiting the firm and there is another Mr. C who is coming in his place, and he is paid a monetary consideration of, let us say, 50 lakh rupees. So would 45(4) come into picture? Yes, provided the money was in excess of the capital account balance of Mr. A. But section 9b would not come into picture in this particular situation, right? So this was the basic provision related discussion. Now, because I am a student of law and I really value the legal words of the of the statute, one point I would like to highlight. If you look at the provisions of section 9b, okay, I would not read it in detail, but I'll just read the first line. It says, where a specified person receives during the previous year any capital asset or stock in trade, so and so, so and so. So, when we speak of capital gains, first things first, I think all of us are aware that it is one particular head of income which has a lot of charging sections. So usually every head has just one charging section, which is the first section of the chapter usually. With capital gains, we have close to 8 charging sections, 45(1) being the base charging section. And the usual tone of this entire chapter of capital gains is that the trigger for capital gains is only when there is a transfer which has taken place. All right. So unless and until there is an element of transfer which is involved here, there is really no capital gain tax liability which comes into picture. But if you see the way 9b is worded, okay, nowhere it refers to the fact of transfer. It just says that where a specified person, meaning in our case where a partner receives a particular asset or stock in trade. So they have changed the entire trigger for this particular transaction from transfer to receipt. That's the first thing. Secondly, even 45(4) for that matter, 45(4) also has similar wordings. But if you have noted, 45(4) starts with the words notwithstanding, which means that it has an overriding effect over all the other provisions of the chapter or the act, correct? So even though 45(4) also deals with receipt, 45(1) does not interfere with it because it has no power over it. So both 45(4) and 9b are discussing a situation where taxability arises on receipt by the partner. Right? Now, when we speak of a very legal angle, the term receipt also has different connotations and interpretations around it. It could be an actual receipt or it could be a constructive receipt legally when we speak. So constructive receipt is something you receive a right to it. Actual receipt is you actually receive that particular asset or thing or whatever is vested in you. So one question which would eventually arise, as this section popularizes, as there are more transactions which take place, which will trigger this section. What meaning would one assign to the word receipts? Whether it is necessary that there is an actual receipt of the asset or the stock, or a constructive receipt is also sufficient to trigger the applicability of these provisions. I'm sure most of us must have thought of this, may not have thought of this, but this is one thing which certainly we need to look at, because the word receipt has a wide meaning of import, correct? So to my mind, I wouldn't really like to give a view on a platform like this, but when I'm speaking of section 9b at least, which is a deeming fiction, I wouldn't want to read too much into it, and I would like to stick to the fact that there has to be an actual receipt in order to trigger taxability in terms of section 9b, because it is a deeming fiction at the end of the day. Correct, but then one cannot deny this particular argument creeping in sometimes. So if there is a constructive receipt of some stock in trade, you're just given some document which gives you makes you the legal recipient of that without actually receiving the possession. Would the taxability be triggered in that uh, context as well? Is one particular thing which comes to my mind. Second is, because we are talking of reconstitution here, where the partner can remain in the firm, he might not exit it, but there is only a change in his PSR because of which he is given some particular consideration. So let us say there is a reconstitution and the partner is his account is credited with some amount as compensation for his profit sharing ratio being reduced or modified. I'm talking of a scenario of 45-4. Correct? So in this particular case, let us say amongst the partners, they have an understanding to the effect that even though the partner is being credited or his account is being credited with so and so amount, the right to withdraw this amount will vest in him after 5 months, 1 year, or on happening of a particular event, etc. See, ultimately, partnership is something which is a mutual agreement between the parties involved therein. So we really don't draw much from income tax law as far as how we frame the agreement amongst partners and all is concerned. So suppose there is a situation that without the right to withdraw the money, the partner's account is credited with some money by virtue of 45-4. Would this still trigger taxability? Can we say that the person has received the money so as to pay tax on so as that the firm is liable to pay tax on it under 45-4? So this is again something, which possibly we will know with the efflux of time, because there might be too many questions of this nature which will evolve once the transactions start taking place. So these were two right now which I have highlighted. Now I would like to go to the illustration which I have in mind for this particular provisions. So this illustration is borrowed from the CBDT circular only. Only thing is we would just read or have a look at it with the background of these provisions so that we are in a better position to understand. Is this clearly visible? Can someone just confirm that? Or do I need to zoom it a little more?
No, ma'am, it's visible. It's readable also.
Okay, okay. Thank you. Yes. So this is the example in the circular, which is there. Now there are three partners in a firm. Let's say A, B, and C, having equal share, that is 1/3 each. Each partner has a capital balance of rupees 10 lakh in the firm. Now there are three pieces of lands, say S, T, and U in that firm, and there is no other capital asset. So very simple structure we have just picked up. And the book value of each of this plot of land is say 10 lakh rupees. So which is equivalent to the capital balance of the partners. All these three lands were acquired by the firm more than 2 years ago. Now, partner A wishes to exit the firm. So there is a reconstitution which is being planned, and the firm, in order to assign whatever is payable to Mr. A, the firm revalues its lands based on a valuation report obtained from a valuer as defined in 11U. And as per that particular valuation report, the FMV of the lands ST is 70 lakhs each, whereas the FMV for land U is 50 lakhs. On exit of partner A, the firm decides to give him 11 lakhs of money and land U to settle his capital balance. Right? So 50 lakhs is the value of land due, which is going to be given to Mr. A along with 11 lakhs of money. Now this is the balance sheet of the firm. As you can see, there is A, B, C, the capital balance. There is land STU. This is pre-revaluation. Now we're going to do the computation of tax under section 9B. Because this is a case of reconstitution and the partner is naturally receiving some capital asset along with money, the first part that we are going to do is section 9B computation. So for 9B, we are going to say the FMV of the capital asset which is received by the partner is 50 lakhs, right? Land was valued at 10 lakhs, which was the book value. Assume an indexed figure of 15 lakhs, right? This is an assumed figure. So we have a long-term capital gain because the land was held for more than 2 years. We have a long-term capital gain of 35 lakhs on which tax would be computed at 20%, which is the LTCG rate, which is 7 lakh rupees. Now this 7 lakh rupees would be paid by the firm because in both the cases, be it 9B or 45(4), the tax liability or the onus to pay the tax is on the firm only, even though the asset is being received by the partner per se. Now here the firm will pay a long-term capital gain tax of, let's say, 7 lakh rupees. We are just ignoring surcharge and cess for the time being. Now section 9B deems that the firm has transferred the land. The effect of the transaction would have to be considered for the capital account of the partner as well. The 9B के context में we are saying that there has been a transfer of the land by the firm. The land is received by the partner, so we are going to modify his capital account balance as well. Correct? I'm sorry. Yeah. So here we are dealing with partner A's capital account. Now his share of tax on this particular amount would come to 2,33,000 odd. By share of profit on revaluation of land U. So land U was for 10 lakhs, correct? It was valued for 50 lakhs, correct? So that is his share of profit in that particular land U. And we have the total balance of 23,33,000. Now for computing 45(4), we have a formula which is, this is there in the section itself. A is equal to B plus C minus D. Now A is the income chargeable to income tax under this subsection as income of the firm. B is value of money which is received by the partner from the firm. And C is fair market value of the capital asset which is received by the partner from the firm. And D is the amount of balance in the capital account represented in any manner. Now this word in the section is also having far-reaching effects. I'll come to it once we are done with this illustration. So D is the amount of balance in the capital account represented in any manner at the time of reconstitution. So what would happen here is cash which is paid to the partner, which is my B figure, okay? Where A is equal to B plus C minus D. So B is the cash which is paid, which is 11 lakhs. C is my fair value of the land U, which came to 50 lakhs. D was the capital balance considering the revaluation of the lands, etc., which was attributable to partner A. Okay, that was the profit on revaluation, which is attributable. That is your 21 lakhs. So capital gains of the firm. Capital gains computed for the firm was, in this case, 35 lakhs. Why does it appear 40? Okay. So yes, in this case, your A would be B plus C minus D. So if you see your B plus C minus D would result into 40 lakhs. which is your 8 lakhs would be your tax on the capital gain of 40 lakhs, which is derived using the formula under 45(4), which is this one. Correct? This is in addition to, please note, this is in addition to whatever you ascertained over here under 9B. Okay. So here what would happen is this firm would again have to pay tax on this 40 lakhs of capital gain at 20%, which is 8 lakhs. So 8 lakhs plus earlier 7 lakhs, 15 lakhs would be the tax outflow to the firm on the event of this particular reconstitution. Now, after understanding this amount of 40 lakhs, we need to determine whether it is a long-term gain or a short-term gain. Now, since 40 lakhs is attributable to land S&T, all the lands were held for more than 2 years. Correct? So it would be safe to say that this would also be a long-term capital gain. Now, that amendment of 48(3), which I was discussing, which is the Rule 8AB, which provides the mechanism for attributing an amount. Now, how does this particular apportionment formula work? Now, what would happen is this same 40 lakhs is attributed to land S&T. Now, what has happened? The firm has paid tax on 40 lakhs of capital gain. Correct? Now, what this particular amendment to 48(3) says is this 40 lakhs will be reduced from the consideration under 48(3) on sale of the other capital asset owned by the firm, which is lands S&T. So, considering the formula in the apportionment, the revalued amount for land S&T was same. In our example, if I can just scroll back slowly with your permission. So if you see here, when the firm revalued its lands, U was revalued at 50, but S&T were revalued at 70 lakh each. So this 40 lakh capital gain, which is determined on the 45(4) section for the firm, this 40 lakhs will be reduced from the consideration when land S&T is sold. Now here maths will come into picture. Now because the revalued amount was same, this 40 lakhs may say 20 lakhs would be apportioned to land S and 20 lakhs would be apportioned to land T. And whenever in future this land is sold, let us say for 1 CR it is sold, then 20 lakhs we would reduce from the consideration because of that 1 CR consideration, 20 lakhs jitne gain pe the firm has already paid the tax. So that is the consequential amendment which is brought out in 48(3), so that the firm doesn't have to pay tax on the entire consideration again when the other capital asset is sold. Right? So this is how 9B and 45(4) would roll out actually. Now there are naturally 2-3 questions which all of us would immediately have. First is, yes, both these sections will apply together. This is the sequence in which we are required to work out the gain. Section 9B would come into picture first, and then we would compute the gain under 45(4). Correct? 45(4) may what is reduced as cost of acquisition, if I can just loosely word it like that, is the capital balance of the partner, which in this case is this 21 lakhs. So before we can find out the capital balance of the particular partner who is exiting or whose PSR is being changed, we need to modify it after giving effect to the provisions of 9B, which is done over here. So first step is you have to compute the capital gains under 9B. This is a separate item on which the firm has to pay tax. Correct? Then you would have to understand what are the changes that have happened to the partner's capital account as a result of the distribution which is made. Take that into consideration and then find out the gain under 45(4). Now the gain which you work out under 45(4), that would also represent a part of gain attributable to the assets which are still remaining with the firm, because essentially all of its assets would be revalued. That is how we would like to understand it. Therefore, 48.3 will then go and say that if the remaining assets are sold at any time in future, then whatever gain was attributable to it would be reduced from the consideration. So I'm assuming everybody is at least with me on this illustration, and then we can go ahead and discuss some more issues related to it. Can we? Anybody wants something to be clarified from this illustration immediately? Okay. Yes. So now let me bring out or highlight 2-3 issues, which immediately I have no answers to those issues, but they are issues which come to our mind when we look at the provisions or the way it has been put up. Okay. Now in this example, as I said, all the assets were revalued. All the 3 lands were revalued, and accordingly you worked out the 9B distribution first, and then you worked out the 45.4 gain. Now commercially, or maybe as an arrangement, it could be possible that all the assets are not really revalued, and the firm only wishes to revalue certain assets, and some assets are still carried at their book value or their old value. How would this 45.4 logic work in that situation? This computation which we did. So that is also something which poses a question. Secondly, this attribution which we spoke of here, of this 40 lakhs into these 2 remaining lands SNT, was easier because the illustration assumed equal amount of revaluation. But if this revaluation is unequal, for example, land S is revalued at 70 lakhs and land T is, let us say, revalued at 90 lakhs, then again you will have to work out that 40 lakhs in the proportion of 70 and 90 each. Okay, so that maths would again change in that particular part. And my third and fundamental question here is, let us in this example, for this Mr. A actually received this 11 lakh of money and this land U. Okay, so decides to give him, we are understanding that Mr. A has received it. Now what would be the situation if their reconstitution deed was worded in such a way that it mentions that it is agreed to pay Mr. A 11 lakhs in money and land U at dash 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 event or after so and so years. So if there is a deferment with respect to receipt of this particular asset or money in the partner's hands, would there really be a trigger for 9B and 45.4? Because both these sections are very specifically talking about receipt. Now, actual receipt, constructive receipt is one thing. What if it is just given to the partner and it is deferred? But yes, commercially, no partner would agree to keep his right like this in deferment. That is another aspect. But these days, you can word your agreements in a multifarious creative way. So then how far would this section be triggered where there is no receipt by the partner actually? Now, on this note, I would move from this illustration back to my PPT. Okay. Is my PowerPoint screen visible?
Yes, ma'am. But right now there's gone to the normal mode. You need to. Yeah, now it's visible.
Okay. Thank you. Thank you. Okay. So then this was the illustration which I wished to cover. There is one more illustration in the circular which we can go through at our convenience. Yes. Now there are 2-3 issues which are not there on the slide per se, but I would just like to bring them to the notice of the partners. I mean participants. Sorry. Now there can be a situation wherein there is a piecemeal distribution in the firm. So entire payout is not happening at one go, but it happens in installments or it is phased out. How would these provisions then be applicable? And that is also one particular issue which one needs to understand. Second case is, let us say there is death of a particular partner, and as per the terms of their partnership agreement or their understanding, his share would be assigned to his legal heir. Right? So whether the legal heir, when he is entitled to the deceased partner's share, would it also amount to the partner receiving these amounts from the firm? So see, let me be very upfront and honest. These issues would come, and I'm sure they'll start coming very soon because these provisions are now operative. But there are no concrete answers that one has. You know, we have to fall back on precedents. That what was the situation in case of 45(4), whether the legal heirs were taxable, what would happen if the partner was alive and in place of him, his legal heir decided to join the firm. So those are things which will help us understand what would be the taxability in this context. But we don't have any concrete answers as regards these provisions. Now, if we look at this particular aspect, like I said, if I just keep my section on 45(4). So 45(4) is talking about capital asset or money which is received by a partner. Now, let us say there is a particular case wherein the partner is paid in some foreign currency. Whether we can say that foreign currency is equivalent to money, or because it is a different currency, whether it would take the character of capital asset in the partner's hands. Now, as far as 45(4) is concerned, I am neutral because in both the cases, the section is triggered. But if I was speaking of 9B, it doesn't include the element of money, right? Money is not what is forming a part of consideration when I'm determining capital gains under 9B. But if there is some amount which is paid to the partner in foreign currency, can the department take a stand that it represents capital asset and hence 9B is triggered? We don't know. In my view, money is money, whether it is Indian currency or a foreign currency, and it really cannot be capital asset even in the terms of 9B. But these are open issues which come to my mind, which when we read or discuss on these provisions. So that is one aspect. Second is 9B deals with stock in trade, correct? Now, just let us try to understand a situation. The transferor or giver in this case is the firm. So whether a particular aspect is capital asset or stock in trade has to be seen from the firm's perspective, to my mind. So whatever is stock in trade for the firm might be a capital asset for the partner. So in future, when the partner decides to sell that particular capital asset, if any of you here remember 45(4) as it was prior to all these plethora of changes taking place. So let's say Mr. A is partner in a firm, and let's say the firm deals with some form of goods, say XYZ goods. So Mr. A is receiving certain value of XYZ goods. Let's say it's a jewelry firm, right? And the partner is receiving some gold coins, which is stock in trade for the firm. Now, in future, when Mr. A decides to sell these gold coins, would he get any benefit in respect of the cost on which the firm had paid tax? That was something which was envisaged in the earlier provisions, which is not there in these sections. To my mind, there would not be such benefit which would be passed on to the partner when he sells these capital assets in future, because the provisions have been made more specific, and in both the cases the taxability is affixed on the firm. So I don't think that would be possible, but yes, these are open questions which do crop into the mind when you read through these provisions. So these were two more things which I had to say on this particular 9B and 45.4 aspect. Yes. Now I just mentioned the word represented in any manner. Okay, just before I go on to the next set of changes, I would like to highlight that part also. So I'm just reading that one line of 45.4 from the statute book, if I may. So it says, notwithstanding anything contained so and so, so and so. I'm not reading it in detail. Now, if we come to the amount D, which was there in the Word file, which I opened some time back. So D represents the amount of balance in the capital account represented in any manner of the specified person in the books of accounts of the firm at the time of its reconstitution. So I have really not completely understood the magnitude of these words represented in any manner which is used over here. So whether it is going to include the revalued amount also is an immediate question which had come to my mind, because see, the capital account of capital balance of a partner at the time of reconstitution. So there might have been an earlier revaluation and the effect of that has not been given. It is still lying in the revaluation reserve, or it could be any this in represented in any other manner as such is something which makes me wary. It is not explained anywhere. So we really need to understand the implication of what that term means. So to my mind, there is some revalued figure which it tries to take in its ambit. That is how I understand it. But then it says at the time of reconstitution. So I would then like to understand it in a way that pre-revaluation, whatever was the balance, that is the one which we are to adopt when we are looking at figure D in that particular formula. So these are some of the issues and the changes with regards to taxability of amounts which are received by partner on dissolution or reconstitution, which we have tried to cover in over here. Now, if there are any questions, you can please put them up to the organizers. We would take them in the end. Now I'll move to some more changes which are there in this particular head of income. Yes. Now, before I go to the first change which is mentioned on the slide, I would first like to take up the second aspect, which is transfer on goodwill. Now, Finance Act 2021 brought with itself some really landmark changes, and one of which was that it totally abolished the depreciation aspect on goodwill. So it said that goodwill would no longer be an asset which would be eligible for depreciation, and it also provided mechanism for removing goodwill from the block of assets and for computation of capital gains, which is under section 50. Now, a small anomaly was there in that case, which was with respect to how would one reduce, what would the transaction of reducing goodwill from the block amount to? So Finance Act 22 has clarified it, that to give effect to the clarification of reducing the WDV of goodwill from your block of assets, whenever that exercise is conducted, it will be treated as a deemed transfer in terms of capital gains. It would not really result into capital gains at all times unless there is some amalgamation related goodwill which is actually revalued and brought into books. But yes, you're reducing the WDV from the block of assets is going to be treated as a taxable transfer in terms of capital gains. That is the small change which is brought about by Finance Act 22 to give effect to this amendment of 21. So it's a consequential amendment basically. I would then move to the first point which is mentioned on the slide. Now this deals with the provisions of bonus stripping and dividend stripping. Section 94, if some of us are aware, they are dealing with special provisions to counter check the avoidance of tax. So when people buy some units at a loss, and I mean at a profit, and then sell them at a loss and try to take benefit of that loss against the dividend, etc., which is received, these provisions come into picture. Now, only change which is brought here is they have expanded the scope of units and shares to which sections 94.7 and 94.8 would be applicable. So earlier, 94.7 did not cover units of InvITs or real estate investment trusts or AIFs. So now 94.7 covers that. And dividend stripping, which is 94.8, was earlier not applicable to shares. So now 94.8 will also apply to shares. Now this first change is resultant of Finance Act 22, which I have discussed. I mean, this entire slide deals with changes of Finance Act 22. So these were two other changes which were brought about by virtue of amendments of the Finance Act to this particular chapter of capital gains. Now I'm just hoping that all this partnership aspect which we discussed and the issues that I brought out are clear to most of us. So then I will proceed to the second part of my presentation. We're already, I believe, 1 hour plus down into it. So this will cover all my recent decisions and some aspects about joint development agreement and section 54 exemptions and developments on that front. And after that, we would take up the questions. So this should take another 40 odd minutes, 45 minutes. Okay. So usually, just to give you a brief, to break the monotony of the talk, I would just say, now typically when we look at capital gains as a head, so the provisions here have a very big bearing from the facts also. So if you look at JDA related case laws, or if you look at section 54 exemption related case laws, it is very difficult to actually find a ruling which would apply uniformly to a very large number of cases. Because to my mind, the manner in which your agreements are drafted, the manner in which your transaction take place, all these factors have a very important role to play when you put up your case. So if we speak of joint development agreement, whether there is a transfer of possession when you are assigning rights to a developer, or the possession is to be transferred only once the structure is ready and complete, or before this entire situation only you are transferring your entire ownership to the developer. What way the transaction is envisaged and worded in your agreement has a very big role in determining how the transaction will eventually be taxed. So we come across really different and unique cases when we look at this entire capital gains head of income, and maybe as is in the case of 37(1) or business disallowances, the rule of law there is very clear that if this XYZ happens, it is allowed. If it doesn't happen, it is disallowed. But here you have to understand every transaction in a very detailed manner before you actually decide upon the matter. So I have tried to pull out some interesting rulings of recent times of various tribunals just for enlightenment of our members, and they have some unique situations therein. So the first decision which I have on my slide is of Mumbai Tribunal. Now in this particular case, I have picked it up because we have been discussing partnership and related taxability at great length. Now in this particular ruling, what had happened is there was a particular partner who had sued the firm on some various aspects, right? And in some kind of arrangement, a particular award was determined for the partner. So it was called as an arbitration award. It was a considerable amount, some few crores, which was paid to the partner. But the MOU or the document under which this arbitral award was paid to the partner by the firm did not really mention of any term that the partner was retiring or there is a particular reworking of her share in the firm, etc. So it was merely paid with the background that there were some other legal hassles and issues which the firm and partner were going through, and in lieu of the partner dropping all those things, this is particular amount would be paid to the partner. So in the department in this case held that this amount should have been taxable as business income under 28(4). But the firm, but the tribunal here said that there is no mention of retirement or there is no hint that she is being compensated for any particular changes to her share in the firm. So it would not be taxable as capital gains and it would not also be taxable as 28(4), which is your business income. So this was an interesting ruling which had come up. Now the citation is put up on the slide in case anybody wants to find that out, you can access it. The next ruling which I have brought out is with respect to a joint development agreement. Now, friends, as you must be aware, we have a number of complications when it comes to taxability of JDA. Though in 2017 we had 45(5)(a) come into the statute, which gave us specific guidelines on taxability of capital gains under JDA, still, it is difficult to say that section is uniformly applicable, one. And secondly, there are so many joint development cases pre-2017 and which have such unique scenarios that because 45(5)(a) is inapplicable, we still have to find out a way as to how joint the gains are going to be taxed in that particular situation. Now here is the Bangalore ITAT ruling wherein the developer was just given a permissive possession of the property. So he was not given any particular legal rights to the property. He was not given any legal rights to the property, but he was given a permissive possession, which was restricted to giving him the rights to develop that particular property. Now, in that particular case, the department held that the moment you had given possession to the developer to develop the property, there was a transfer and the assessee was liable for capital gains tax. Now, naturally, this is a pre-2017 issue which is there. Most of the issues are prior to that only. So in this case, the Bangalore ITAT held that legally there has not been any transfer which is made to the developer. The only limited rights as documented in the joint development agreement were those of giving him possession to the extent of developing the property, which is a permissive possession. And therefore, this cannot be treated as transfer and there would be no capital gains tax in the year in which the JDA was entered. So this was the outcome of this particular ruling. Now, this is a very interesting ruling which I came across, and it's a High Court ruling. So most of us would find it useful in one way or the other. Just give me a minute. Thank you. Now here, earlier there is a person purchased a property and registered it in the spouse's name. And on that property, 54 exemption was claimed because section 54 doesn't debar any assessee from claiming exemption under that section, even though the property is registered in spouse's name as long as the money was paid by the transferor, correct? So in this situation, firstly, when the property was acquired and registered in the spouse's name, it was considered eligible for 54. Now, when the assessee afterwards is claiming exemption under section 54F, there is a eligibility which has to be determined that you cannot own more than 2 houses apart from the one which you're intending to buy in order to claim exemption under section 54F. So here the Karnataka High Court has held that investment in property which is registered in spouse's name is eligible for exemption under 54. You cannot construe it as it is owned by the assessee for determining eligibility under section 54F. So this is favoring the assessee naturally. So they say that earlier you said that 54 we are granting because even though it's registered in the spouse's name. So when you are counting the number of residential houses for determining eligibility under 54F, you cannot say that that house is also belonging to the assessee or owned by the assessee, because you yourself have allowed 54 exemption when it is registered in the spouse's name. I don't know how far this argument can be stretched, but certainly for now it is a favorable ruling for us. The next one again is a Bangalore ITAT ruling. I'm sorry, I've missed the citation on this one. This is in case where there is a capital gain on a joint development agreement, and the ITAT here rules that it will not be taxable in the year of agreement, but in the year of possession of assessee's share, where municipal authority's sanction was received in the subsequent year and no development activity took place in the project during the year of entering into joint development agreement. So here basically what had happened was the JDA was entered, and for some time after the JDA was entered, there was no construction activity which took place on the land which was transferred. The department still held that this particular JDA is taxable in the year in which the assessee received possession of his share. But in this case, there was municipal authority's sanction which was received in the subsequent year, that is after the year in which JDA was entered. So they said that it will be taxable in the next year, that is wherever the activity has taken place and the assessee has taken possession of his share of the developed structure. That is the year in which you would be taxing the JDA and not in the year of agreement. So again, this is on the premise that JDA would not be taxable immediately in the year in which you enter it, but at a later year when assessee has actually got hold of his share of the constructed building. Now these are 3 or 4 rulings I have come up with. Now just on this note, I will stretch this discussion further, talking about JDA. Right now, as we are aware that 45(5)(a) was inserted in 2017, and it gives us the scheme for taxability of capital gains on joint development agreement transactions, and it is from the year in which your occupant completion certificate is received from the authority. Now this has kind of settled the position after the section came into the statute books, but we see a number of situations pre-2017 where different tribunals or different judicial fora have given different rulings based on the facts of a case. So in most of the cases, assessee is trying to defer the taxability of JDA to a later year. Okay, and his agreement is worded in such a way that the property will come into existence 2 years hence, and assessee will get hold of his share of the property, and that is the time when transfer will effectively take place. The revenue, on the other hand, is always keen on taxing the JDA in the year in which it is entered, as we can see in these 2 or 3 rulings which I brought up. Because for them, once you hand over your particular share of land to the developer for developing it, the transfer has taken place. So this is the usual scenario which we see, but sometimes opposite also happens. For example, if it is favoring the assessee to offer the capital gains to tax in the present year, maybe there is some benefit which he has in terms of losses to be set off, or there is some other benefit which he is intending to take. So in that situation, their JDAs would usually be worded in such a way that they are transferring the rights of the land and the possession to the developer immediately, that is in the year of entering the JDA. So in those circumstances, the assessee claims that the taxability year for capital gains should be the year in which the JDA is entered and not when the possession is handed over to him. So we are seeing cases both ways. Okay, wherein sometimes they want the gains to be taxed in the year of possession. Sometimes they want it to be taxed in the year of transfer. Now, for all cases pre-2017, what is of importance is the way in which your joint development agreement is worded, because every case will have some unique terminology in its agreement which might sway its taxability in one way or the other. Now, this was something which I wanted to discuss about the pre-2017 JDAs. Okay, there is one small aspect as an academician, it comes to my mind, which I would want to discuss, which would be relevant even after 45(5)(a) has come into the statute book. And for this, I would just like to read 2 or 3 lines from 45(5)(a), so everybody would be with me as to what point I am trying to highlight in this particular case. So if I look at 45(5)(a), so I'll just read out some relevant parts of it. Notwithstanding anything contained in subsection 1, where the capital gain arises to an assessee being an individual or a HUF from the transfer of a capital asset, being land or building or both under a specified agreement, the capital gain shall be chargeable to income tax as income of the previous year in which certificate of completion for whole or part of the project is issued by the competent authority, and for the purpose of section 48. Now section 48 is our computation. For section 48, the stamp duty value on the date of issue of the said certificate of his share. So what I want to highlight here is, for the purpose of section 48, the stamp duty value of his share, being land or building or both in the project, as increased by the consideration in cash, will be deemed to be the full value of consideration. So see this from 2017, when this section has found a place in our statute books. How does this section read? It says that first of all, there is a transfer of a capital asset, which is land or building. And when you speak of the computation part imbibed in the provision, it says that the stamp duty value of his share of land or building, his mane, the transferor who is the individual or the HUF. Now, the way I see things is, there are two scenarios which come out of this particular section. The first is when, let's say I own a plot of land and I want to get it developed. So I enter into a JDA with the builder who has agreed to construct a 10-floored structure on my land, and he is going to hand over 2 floors of the constructed building to me. Okay, this is the basic situation. Now the first case is, I agree to transfer my entire undivided rights in the land and building to the developer immediately. That is the first scenario. Second scenario is, I am transferring only my share, which is let's say the whatever amounts to that 2-floored which is being constructed. That is my share of the part in the JDA is being transferred. Now the point that I'm trying to just highlight is, it's of course an academic point, but how you draft your agreement is going to determine it. Now, if at all I am handing over the entire what do you say, a share in my land and building to the developer, and the way it is worded is, it could mean that for computation 45(1) would come into picture. So the capital gains for the entire project would be computed, and then my share would be allocated. Whereas if I am restricting my terminologies in the agreement only to my share, that is share of the assessee. In that aspect, when I'm looking at 48 computation, 45 5A would come into picture, and the stamp duty value which pertains to my share along with the money in terms of cash which I'm receiving would be my full value of consideration. Now, this is totally something which is which is based on the language which is used in the section. I would still say that post 2017, the law on taxability of JDA is more or less settled, but one has to still be careful in terms of how your JDA is drafted. What is the right which you are assigning to your developer? When is the possession transferred? When is the legal possession going to be transferred? When is transfer under 45 5A to be triggered? All these nuances have to be kept in mind. So this was about JDA. The next aspect which I would highlight here is with regards to exemptions under 54 or 54F. That F is missing on the slide. So again, when we speak of 54, just to give you a brief background, Section 54 exemption is
Hello. Am I audible?
available to individuals, assessees who have sold residential house and they're investing the consideration in one residential house.
Ma'am, hello. I'm sorry, you are not fully audible, ma'am. It's getting muted in between. Hello.
Hello, am I audible?
Hey, yes, ma'am. You're audible now. I'll just give back the rights. Actually, your connection was lost, it seems, so for last 10 to 20 seconds or so.
Okay.
Not for a minute, it's just for 30 to 20 seconds actually. So you are not audible actually. So we can't able to see your face also. So we are not quite sure what happened.
No.
Now it's restored, ma'am. You can continue for last.
You can view my screen. You can view my screen.
I can view the screen. Yeah.
Okay.
Issues the page.
So I will keep my camera on because this is the last slide I'm discussing on. So I don't think it'll be too much of a bandwidth problem to navigate.
Understood. Understood. You can keep it on and you can continue.
Okay. But I'm still getting the message that you are experiencing network connection difficulties. Please close any unused internet application.
That's not a problem. That's not a problem. You can just ignore it and you can continue. If there's any lag, it will automatically turn off your camera. No worries.
Okay. Thank you, sir. Yeah. Okay, so I believe with the entire discussion on 54, I just started a couple of seconds back. So I'll just resume it from there.
Yes,
so,
yes, please.
Okay. So the point that I was making was Section 54 has evolved in a great way, considering the judicial pronouncements that have taken place in relation to that section. So 2014 onwards, we have specific terminologies inserted in that section, such as it should be one residential house, the house should be located in India, etc. So now we are settled on the position that Section 54 exemption is available only if the assessee is acquiring a residential house in India. But the aspect about one residential house, which the section uses as a residential house, is still a matter of debate. The reason being that there have been several set precedents which have clarified as to what can be treated as a residential house, so or one residential house for that matter. So if there is a common residence, if there is a common kitchen, despite the fact that one or two flats are clubbed into one structure, there have been rulings which say that it can be treated as one residential house. On the contrary, there have been some contradicting rulings also, wherein the assessee has acquired two neighboring flats in a building and he has demolished the wall and clubbed them into one, and he has tried to claim exemption under Section 54. So there have been ICAI rulings where they have held that it cannot be treated as one residential house. So these are, like I said, capital gains and the entire scheme of law in this particular head of income is very fact specific and very transaction specific. So when one is really aiming to get an exemption under Section 54 or so, you have to closely understand how your facts are working and what rulings are there in your favor. For example, one and a half year back approximately, there was a Ahmedabad tribunal ruling wherein there was a huge joint family and they had purchased some 4 or 5 flats in an entire building, and they had claimed exemption under 54, saying that theirs was an entirely huge family and they needed that entire area as one residential unit. They were all living in a joint family setup. So despite the fact that it was a collaboration of multiple residential units, the court allowed it as one residential unit basis their facts. So issues like one residential house, investing in a residential house in your spouse's name, or putting your spouse's name on the agreement, but you putting in the money, or jointly investing even though the old property which was sold was entirely on one of the individual's name. These are very typical issues which come up when we are dealing with taxation for individuals or HUFs. So one has to very clearly understand what is the jurisdictional ITAT or High Court's view on the matter. So maybe Mumbai ITAT is allowing it, but if I look at, let us say, Delhi ITAT or Bangalore ITAT, they might have a contradictory ruling, and if you are based in that jurisdiction, you are bound to be disallowed the exemption. So that is one aspect. Again, when it comes to 54F as well. So recently, 54F, you're selling any particular asset and you're investing in a residential property. Now, recently we came across a ruling where an assessee sold some shares or some other asset. He purchased a particular residential property. He claimed exemption under 54F, but it was immediately converted into a commercial property. So subsequently, his case was kind of reassessed, but the tribunal held that when you acquired it as a residential unit, subsequently, even if you convert it into a commercial one, it cannot debar you from your exemption. So what I'm saying is these entire ambit of sections which are there for capital gains are very, very specific ones, and they have a very overbearing importance of the facts also. It's not like business income or residential status wherein one rule applies to all. So planning your tax around the available provisions of these sections is very important. You have to keep the facts in mind, your jurisdictional codes rulings in mind, and then you can actually go ahead and take benefit of these provisions. Yeah, so just so we can. You want me to move to the questions, sir? How is it?
Yes, ma'am. How do you want to take it up, ma'am? We have compiled the question. Actually, we have close to 15 or 12 questions actually.
Yeah,
So do
we
you have
could,
any deliberation to make, or else we'll take up the question straight away?
we could take the questions. If there is anything else which strikes to me as needs some more elaboration in the course of
Yeah,
answering the
maybe.
questions, I'll do that.
Yeah, then you can
So
continue. I'll just share my screen,
I'll
ma'am.
stop sharing my screen.
Yeah, please.
Okay.
Now I've started sharing my screen. Is my Excel sheet visible?
Yeah, I can read them, yes. So the first question is, in case of sale of flats by an individual, after the date of completion certificate received as a consideration for transfer of inherited land under JDA, can we claim exemption under section 54 or 54F? Okay. So you have transferred your land, in lieu of which you have received flats, which are subsequently sold, right? Is this the sequence of events? You have received some land, transferred some land under JDA. As a consideration, you have received some flats, which you are later on selling. Can we claim exemption under 54 or 54F? How to calculate period of holding? So I think 54 would not be possible here, because 54 envisages a situation where a residential house is transferred and another residential house is acquired. 54F could be possible because you are selling a land, or you are transferring a land under JDA, in lieu of which you are receiving flats. So for if at all there is any gain in view of the flats which you have received, for this transaction you can claim exemption under 54F to my mind. How to calculate period of holding? Is it from the date of holding by the previous owner or date of JDA? So if you have inherited the land, I think as per your Manjula Shah ruling and 49(1), your previous owner's period of holding would be accumulated in your period of holding. So your period of holding would be starting from the date when your the person from whom you inherited acquired it, and ending on the date when you entered into the JDA for transfer of the land. Can exemption under 54 or 54F be claimed? No, 54, 54F both are in respect of long-term gains. So I think, yeah, 54, it was only for LTCG. Yeah, second one. In case of transfer of land under JDA, the year of taxability is the year in which completion certificate is issued by the competent authority. This is, yes, as per 45(5)(a) from 2017 onwards. If the landowner receives constructed flats in consideration of such land transfer, is he liable for capital gain tax in the year of issue of completion certificate? And if he transfers the flat so received in the subsequent year, is he again liable for capital gains on the subsequent transfer? Okay, so now we should understand there are two transactions here. First is, you have given your share of land, in lieu of which you are receiving the constructed flat. So your understanding here is right. If it is from 1st April 2018 onwards, then you would be taxable in respect of the gain for constructed flats in the year in which the project receives the completion certificate. So that answers the first question. Now this transaction of capital gain is completed here. Now you are owner of the flat, and suppose in the next year if you are selling the flat again, that is again another transfer. Now your land co-op flat transaction has ended. So when you sell your flat and maybe you receive money in terms of it, it is another transfer. So there will be again a capital gain in respect of that, and it would be a short-term capital gain if you are selling it immediately in the next year. If it is beyond 2 years, it would be a long-term gain. Third question. Capital gain on compulsory acquisition is not taxable as per RF. That's a Land Acquisition Act. How do we present it in ITR and also recover the TDS deducted under 194 LA? Okay, your point of law is clear here that it is not taxable, but I am sorry, I would be of little help as far as the presentation in ITR goes, because I don't really, do compliance in a very big way. But to my mind, there should be some field in the capital gains schedule which is there as to non-taxable gains, or so maybe how we have in the case of 1037, something similar.
Ma'am? Ma'am, your audio is not connected. Audio is not connected, ma'am. Sorry. 1 minute, 1 minute.
It says audio connection restored now. Okay, ma'am. Okay, sorry.
Ma'am, I will go back to the question.
Yes. Sorry. I think there is some.
Yeah, no problem, no problem.
No problem.
Yeah, it happens. I mean, virtual session, it happens. No problem. We'll resume from where it was.
Thank you. So I'll just keep my camera off. Maybe
No
that.
problem. We'll keep it this way. Yeah.
Yes. Okay. Yeah, I think this one I answered. Now, as far as presentation is in ITR is concerned, I would not really be of great help here. But just like we have a separate column for 1037, we would have something in the capital gain schedule. One would need to figure. I don't deal with compliance much. And as far as the recovery for TDS deducted under 194 LA is concerned, you can put up a request on your portal in that case for that specific PAN number to your what you say TDS officer, and that way you can claim the refund for the TDS which is deducted. It will also appear in your 26 AS when you are furnishing your return of income, and if you don't have any other taxable income, you would automatically receive it as a refund in that case. Additionally, you can also put up a request saying that your gain is not taxable. Okay. If a land purchased by Mr. A at less than stamp duty value is gifted to his sister Mr. B, what would be the tax implication in the hands of B if B sells it at value equal to stamp duty value? Okay, so because they are related to each other, even if Mr. A is gifting a land to his sister, firstly, there would be no tax implication either for Miss B or Mr. A as far as the transaction of gifting is concerned. Okay. Now, what would be the tax implication if B sells it at a value equal to stamp duty value? In that case, the consideration, that is the stamp duty value, would be taxable in Miss B's hands, and whatever was the price at which Mr. A acquired the land, that would be her cost of acquisition. Right. Next one. With reference to the illustration discussed, and as per my understanding, the capital gain taxed under 9B and 45(4) is a double taxation, and the effect of nullifying double tax, the act prescribes that for the capital gain taxed under 45(4). See, to an extent, yes, I agree with the fact that there is double taxation and the reduction from other assets. That is the 48(3) thing you're referring to, I assume, at the time of consideration of sale, which is the amendment made to 48(3). That is one attempt at reducing the tax implication for the firm when other assets are sold. So to an extent, yes, it is one small effort in that line, but then that will nullify the effect of double taxation with respect to the other assets which are still remaining. As far as the asset which is transferred to the outgoing partner, there would be one computation under 9B and there would be one computation under 45(4) also. So that 15 lakhs which was there in that illustration, that would still remain. There are representations made by various forums on this, but we don't know because they already made the change from bill to act. No? So I think we need to live with this now. But yes, it is one small attempt at reducing the double tax. In a way, yes. In a way, yes. But I would not be in a position to comment more on it because as and how the provisions are applicable in real life, we would understand its implications more clearly. How the double tax is mitigating by adjusting into sale consideration at the time of sale of other assets. The double tax has to be provided as a credit to tax. No, sir. Here, I mean, the double tax they're trying to reduce by simply reducing the capital gain on which you paid a tax earlier from the sale consideration for other assets when you sell them. That is the way they are trying to reduce the consideration amount and in turn the amount of tax which is to be paid. It is a very what word one can say, it is a very draconian provision to my mind, but they might have brought it with some intention. So the double tax is not provided as a credit. The double tax is sought to be reduced by taxing the consideration at a lesser amount when there is a subsequent sale of other assets. Excuse me. If there is an ancestral property which is sold and the investment is done in the name of the spouse of the people who have received the consideration, will exemption under 54 will still be applicable. Okay, so as far as I understand this question, Mr. A inherited some property, he sold it, he's buying another property and he's buying it in the name of the spouse. I think that should not be a problem. There are rulings which favor that you can purchase a property or register it in the spouse's name. But there should be a singular ownership of the transferor on that ancestral property. It should not be the case that it is owned by that assessee and his brothers and it is the, I mean, jointly owned property. Then it will be a bit difficult to prove the nexus. Okay, we can scroll down if there are any more questions. Hello? Hello?
Ma'am, sorry.
We can scroll down if there are any more questions.
Which question, ma'am? It is on JDA.
This one which is on the screen right now, yes. A JDA was executed. A JDA was executed in 2018 for development on 3 acres of land with sharing of 60% to a developer and 40% to owner. Land on 2 acres of land was developed and 40 flats were constructed and OC was received during 21-22. Another part of 1 acre is being developed in a phased manner. Can the owner offer capital gains? Yes, because it is post 2017, so completion certificate is received for whatever part, that part can be offered to capital gains. The part which is still going on, that need not be offered yet. Please explain the impact of proviso to 45(5)(a). Suppose one property is sold out of many received, whether tax has to be paid. Okay, I'll just look at the proviso of 45(5)(a). Just give me a minute. So 45(5)(a) says, provided that the provisions of this subsection shall not apply where the assessee transfers his share in the project on or before the date of issue of the said certificate of completion, and the capital gains shall be deemed to be the income of the previous year in which such transfer takes place. Okay, so this proviso was what I was discussing in the post 2017 situation. So assessee transfers his entire, the entire land before for entering into JDA, or assessee transfers his own share before this CC is received. So supposing there is the assessee enters into a JDA, and even before the completion certificate is received, the assessee is transferring his share in favor of the developer or any other person, then 45(1) will be the computation provision which will be used, because 45(5)(a), the reference to section 48 is very clear about his share. All right. Suppose one property is sold out of many received. So here I don't think you can break out his share again into multiple parts. His share will be the entire share. So suppose he is slated to receive 3 properties and out of that one he is selling. So I cannot say that only partially my share is transferred, because it refers to his share, it would be in entirety. So it would be 45(1) if I sell my share before receiving CC, and it would be 45(5)(a) if I am holding on to it till the time I receive my completion certificate. Inherited property was given for joint development, for plotted development. The land is in the mother's name. Can we pay the JD tax in all the family members' name, as they have the right in the property for inherited property, and declare the share of consideration as business income after paying? Okay, this is a very complicated thing. First of all, if it is in the mother's name and she is still alive, then you need to have some form of family arrangement wherein the other members also have their rights in the property assigned. In case she is deceased and there is a will, then it will go as per the will, and can declare the share of. Now this would be very difficult, because you would have to show that you are in the business of developing properties, and this one of a case, just to gain some advantage of 44AD provision, it would not possibly work out. But again, how your agreements are worded would play a role there. Can we claim section 54 by investing in single independent residential building which consists of ground and first floor? On the face of it, my answer would be no, because one residential unit would naturally have one entrance and one kitchen. But if this is like a 1+1 small bungalow kind, which is constructed like the kind of row houses you have in tier 2, tier 3 cities, you can claim 54. That should not be a problem. Sale of agricultural land, not capital asset, where do we have to report? See, this would form a part of your non-taxable capital gains. To my mind, in your schedule CG, there would be some field in which you would have to disclose it. Whether unlisted corporate bonds sold after 3 years will be eligible for indexation benefits. So for bonds, you have the option whether to offer capital gains with indexation or without indexation. So there is a rate different, but there is a difference in the rate of tax, I think. So you can evaluate that. Yes, if you're wanting to go for indexation benefit, that should not be a problem. Usually bonds are not as such eligible for indexation benefit, but that is, I believe, listed ones. I'm not very sure about unlisted corporate bonds. Just give me a minute. 48 will prevent indexation on any kind of bonds. So if I look at section 48, which is the proviso, it is your provided that where the long-term capital gain is other than So your indexation benefit is not available if it is a bond or a debenture. Okay. Yes. Any more questions?
Yeah, those were the questions, ma'am. We are done with the questions.
Okay.
And ma'am, many were asking for the presentation part also.
I will email it to you on this ID from where I've.
Yes, ma'am. Yes, please. You can share it to us and we'll circulate to the members along with the recordings. Thank you so much for your time, ma'am. We have our regional council member who joined through mobile phone. Actually, he's been joined from laptop, so he's unable to turn on his video.
Okay.
Over to you, sir. Vote of thanks.
Good evening, members. I'm sorry, I'm in a client office. Here, my network is not clear. And I thank the speaker, Prachi Parekh, for giving a detailed explanation on recent developments in capital gains. And she answered all the queries asked by the members patiently. And I'm once again thankful for the speaker, madam. And I thank the members who joined the seminar and have the knowledge of joint development agreement, section 45 and section 54, even on even agricultural land. Also, the members asked regarding capital gains. And thank you, madam. Thank you very much, madam. Thank you.
Thank you.
Thank you so much.
Yeah. Thank you. Thank you all the participants. Thanks a lot.